One of the oldest expressions in real estate investing is all about location, location, location. And, even though we all know this adage, right, and we've all heard about it, oftentimes as investors, sometimes we don't necessarily always follow that rule, right? Like sometimes we'll maybe see deals that look really good on paper, even though they might not be the best locations, and we go chase after them. What I thought I would do in this video, I recently did kind of an analysis of my portfolio. Today I've got just a little bit over $35 million in multifamily assets here in the Boston area. I kind of was doing an analysis of everything, and I kind of noticed a trend of which of my properties performed the best over the last couple of years versus not as well, right? And what I found had very, very much to do with the quality of location. So I'll talk about my findings and the implications it has moving forward as we're investing in a very potentially volatile market in 2024 and 2025. So with that, let's get at it. What's going on, guys? My name is Lior and welcome back to my channel. Now, before I get into the meat and potatoes of the video, two super quick things, guys. Number one, if this is your first time on my channel, first of all, welcome. Second of all, make sure you smash that subscribe button. I put out tons of new videos every single week on this channel talking all different facets of real estate investing. So, if that's something that you're interested in, whether it's construction, financing, management, looking at my own projects, right? Make sure you subscribe, and that way you'll be notified every time I put out a new video. So now with that, let's get right into the meat and potatoes. And as I said, right, we get taught very early on, typically in the investment space, about the importance of location, right? And we all know about location, 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 three most important things in real estate investing, right? But, we do get tempted, especially early on, right, to chase kind of numbers, right? And typically when we chase numbers, right, when we chase cash flows, it leads us to invest in maybe not as great of areas, right? I was doing an analysis recently on my portfolio, and one thing I've kind of realized is, my properties that are kind of in the quality locations and really in the best locations around the Boston area have done extraordinarily well over the last couple of years. Whereas some of my properties that I bought that, are kind of in the changing neighborhoods kind of deal, they've certainly done okay and they haven't been bad or anything like that, but they haven't been as consistent nor amazing in terms of performance, right? And I'll give you guys a couple of examples, right? So when I kind of dug deeper and when I really thought about it, right, my properties that are, again, in these kind of latter areas that are developing, changing, however you want to think about it, one of the common themes that I realized was I tend to have a lot more tenant turnover in those areas. I tend to have a lot more, I tend to have more vacancy on the market after I re-rent the apartments. My turnover cost tends to be higher, right? The tenants typically damage these apartments more. My delinquency tends to be a little bit higher there as well, right? Like I have tenants that are kind of behind on rent in a lot of these areas, right? So all these factors have actually impacted cash flows over the last couple of years. And even though Excel will kind of spit out a number that says you're supposed to cash flow X amount, whatever it may be, oftentimes I'm not really realizing it, in these kinds of areas, right? And then the other factor too is the valuations with these kinds of properties, right? And, especially as we've kind of been in a changing market, right? Given that the interest rates have changed a lot, what I've noticed is that these properties, again, in kind of, fringe areas, if you will, right? A lot of them, I'm not as confident about their valuations as I was maybe a year or two ago, right? Like, I don't know if my buildings that I thought were worth, 1.4, 1.5, whatever, I don't know if they're worth that anymore, right? They might be worth 5-10% less, honestly. And that's just because, again, confidence has obviously gone down in the marketplace. And, if you ask me to sell these buildings today, I don't know if I would get absolute top dollar that I had on my valuations, right? So I might be forced to sit on them for another couple of years until we kind of rebound from this low point in the market and go through this volatility that we're going through in order for me to realize the valuations that I thought I had last year or 2 years ago. In contrast, right, when I was looking at the properties that are kind of in like really, really prime locations, right? One of the good things about them is they tend to have very low vacancy, right? A lot of these buildings I noticed really don't have that much vacancy at all, honestly. If they turn over, I usually have someone ready to go within, less than a week. My turnover cost tends to be minimal, right? I mean, it's not like I have to go in and fix any damage or anything like that. They tend to be, pretty well treated apartments. Don't tend to have a lot of delinquency. Very rare for me to have delinquency in a lot of these buildings. So, from a cash flow perspective, I actually do realize a lot of cash flows that I thought I would, right? And maybe even a little bit better, right? Because again, the building's performing as good or even better than I projected, and that's just a function of neighborhoods, right? Because again, the tenants, you tend to attract a better class of tenants. They tend to obviously make their rent payments. They don't beat up units necessarily as much. Obviously, exceptions to the rule of everything, but in general, that has been definitely the trend. So my cash flows that I realize are actually super, super solid. And then the other factor too is valuations, right? So, even though, as I mentioned before, right, the market has obviously been changing, I would say my valuations in these kind of more prime locations, I'm honestly less worried about, right? I don't expect that I take in as much of a hit on these valuations because these areas are still super, super desirable, right? I mean, in terms of cap rates, they've barely decompressed in some of these areas. Some of them are still very, very tight. They've obviously decompressed as compared to maybe a year or two ago, but it's not like we had major fluctuations in kind of these prime areas, right? So I feel much more confident about my valuations, much more confident about my values there, much more confident about my cash flows. And that's kind of the difference, right? That's kind of the stark difference I've realized after looking at my portfolio. So, what's the implication for you guys watching this? And honestly, for me, as I was kind of thinking about this, well, the big thing is for the next year or two, I think I'm definitely going to obviously prioritize, chasing really locations is going to be a big part of my thesis and philosophy. Even if, the Excel sheet doesn't spit out the sexy numbers on cash flows or whatever that we may want it to, I think these are just going to be very consistent buildings that consistently produce, have less volatility, both in terms of valuations and cash flows. So I'm really going to chase those buildings. In fact, I'm even thinking about potentially doing some 1031s, right? Where I sell some of my kind of not as great buildings in 1031 into some of these better buildings. So I can kind of really, pivot into those locations even more, right? So that's kind of the thoughts that are going through my mind. So, hopefully you kind of enjoyed me rambling about my thoughts about, my portfolio and kind of how I thought about the segments. I think it is really valuable for you guys to think about this, right? Because, I think we're gonna be in it for another 2 to 3 years of probably a fair amount of market volatility, right? And we got to make sure we're making the right moves today so that we can smoothly ride out any volatility. So we could feel confident that we're collecting the cash flows that we think we're going to be collecting, and that our valuations on our buildings are, not going to be significantly changing. So hopefully that's helpful, guys. That's just my 2 cents for you guys. Of course, if you agree, disagree, think I'm stupid, think I'm a genius, whatever, put the comments below and I will definitely help you out.